That sounds like Fundstrat Global Advisors Tom Lee. He joins us here at Post 9. So what is your level of conviction in your bull case for stocks into year end right now?
It's actually high. I know it's been a tough 3 months, a brutal October, but I think stocks are getting washed out now. And the effects of this jump in long-term rates is starting to bite, and I think we'll see it this week in the economic data. I think that's going to push sort of Fed to be patient, right? Because this jump in rates just in the past couple months is equal to 4 hikes. And that should get investors a little more constructive about how the Fed reacts to incoming data. So I think with positioning, economy being okay but slowing, and if rates could stabilize or fall and the Fed turning slightly more dovish, I think it is a formula for a rally.
But what about the leadership in this market? Last week, I mean, it wasn't like the big mega cap tech earnings were awful, but the reactions were.
That's right. I think the mood of investors has turned cautious, so they faded decent earnings. I don't think FAANG's fundamentals are weaker. I mean, they're still at the center of this AI sort of secular story. So I think FAANG actually leads into year end, and that also helps lift the S&P.
But is your view based on the idea that rates are going to start to come down, that it's not going to be higher for longer, and therefore perhaps that we aren't going to see a significant impact on earnings as a result of these higher rates over time?
Yes, to an extent. There was a great report by Goldman Sachs economists about what fair value is for the 10-year. They used 3 models, and they came up with like roughly 3.8%. So the 10-year at 5 is reflecting this uncertainty about inflation, how high the Fed has to be. If the data softens, we're going to start to see investors say, look, the Fed reaction function is if we got unemployment picking up and inflation weakening, they're going to cut. So I think we're seeing the peakish points in the rates right now.
Doesn't the market eventually transition to bad news being bad news?
Yeah, I mean, that's a bad quadrant to be in. If we're slowing, but it's consistent with soft landing, that's bad news is good news. But if it's a sudden slowdown in economic activity because we just ran out of gasoline, that's actually bad news is bad news. So I think right now it's open to interpretation, but to us it still feels like we're tracking for a soft landing.
The other interesting thing, Goldman Desk takes a look today at some of the dislocations we've had within earnings. Morgan Stanley, Google, Verizon, like top 5 biggest underperformances on a T1 basis, T+1 in several years. What do you think that's about?
I don't think it's inflated earnings expectations. I just think the mood of this market's gotten really cautious because of all the geopolitical tensions. I mean, I noticed this over the weekend. Almost every conversation with a friend or family or even a client talks about what's going on in the Middle East. I don't know if someone wants to be adding risk, even if they think the earnings were decent. So I think the mood is cautious. But of course, as you know, when positioning gets too bearish, that's when bad news becomes good news.
I wanted to dig into that for a moment on the geopolitical risk, because you would have thought it might have been more of a bullish factor for bonds if people are feeling so negatively about risk. And the equity impact isn't clear to me, because war can be also very bullish and stimulative to certain industries in particular. So how do you think about all that?
Well, I think that's been a source of confusion, because I spoke to a couple of fixed income clients over the weekend, and they were saying that the bond market is acting like the war is a limited war. That's why you're not seeing a flight to bonds. But the stock market, I think, it's not trying to discount the defense spending issue. I think it's trying to discount, is this leading to a conflict that could become, much larger? And, in that case, people are just changing risk premia. And that's why I think stocks are being hit while bonds haven't been hit. So you're right. If it turns out that the war is a regional conflict, this is actually bullish for equities because stocks converge with bonds.